Hey, it's the Ignorant Entrepreneur, and in a strange turn of events, retail traders have lured big money investors back into the market. Now, let me start this video off a little bit differently. I want to set the scene for you here. It's 11:54 p.m. Thursday night. I'm sitting in my room taking in what people perceive today to be a little bit of a crash, right? The Dow market dropped 800 points. And from my last video and August recap on Jim Cramer's Mad Money, we know that he was saying that it's time to ring in the register. But we also know he and other people have been telling us things like this for a while. And if you've been following the markets, they've been going up for months. So Rob, how have retail traders lured in big money investors? That's easy. The Fed is making sure the party doesn't end anytime soon. Now, for some of those big money investors, now may have not been the best time to do it. We'll see. But let's look into some of the reasons and why, and how this could have an impact on the market. After hitting a record of $4.8 trillion following the market's biggest panic in over a decade, money market funds are starting to decline. Why? The Robinhood-fueled retail trading frenzy is now beginning to make other investors feel left out. FOMO, FOMO, FOMO. There's long been a theory in the stock market that investors would eventually put their excess cash to work. Now, it's known that professional traders went into cash during the market sell-off and are just now starting to put it back to work, while retail traders flip stocks for a fortune. Now, with the fastest rebound from a bear market in history, it's happening. If these big players are really throwing money into the market, it means it could push the market higher. Now, this doesn't diminish what Jim Cramer was saying in my last video at all, and I encourage you to check it out to see what I mean. But to provide more insight, last week the Fed committed to a lower for longer interest rate policy. Chairman Jerome Powell announced Thursday that the central bank is changing how it viewed the trade-off between unemployment and inflation, which means the critical shift is a focus on where unemployment levels are at, rather than inflation. Given the current double-digit unemployment, it's now likely that this latest round of 0% interest rates will persist for years. With both interest rates and inflation rates low, the real returns on stocks relative to bonds or cash in a money market fund look far more attractive, even with stocks at historically high valuations. Next would be the stock to GDP ratio. The stock market to GDP ratio hit a record high recently. That's usually a concern, but with the prowess of retail traders and the Fed together at last, what could possibly go wrong? Why settle for 2% in government bonds when you can get a stock that rallies for 30% just by announcing a stock split? With this in mind, the chance of a severe market decline has become significantly lower. However, the market can be prone to sharp pullbacks should the same retail traders that jump into a stock decide to withdraw their capital en masse. So with the exception of today or yesterday, as it will be tomorrow, retail traders have been having the last laugh. You have had a role to play in the market's crazy, unprecedented bull run. Think about it this way. Big money is jumping in because the Fed is going to keep the party going for some time. The Fed came to the party to avert the disaster that would have occurred if retail traders continued to dominate the market and create even wilder moves. This has been the Ignorant Entrepreneur to give you that other perspective, that other side. Hope you enjoyed this video. If you do, like and subscribe. I really appreciate the support and really looking forward to bringing you even more interesting concepts in the stock market, but also entrepreneurship as a whole. Thanks for watching again. I hope to see you again. Bye.